Yeah,
How you
I'm the
doing?
same Ellie on the channel, by the way.
Y-
The
Oh,
ELI, the one from New York.
oh yeah, 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 yeah. This is your first time on the section, right?
Yeah,
Yeah, welcome, welcome, welcome.
thank you.
All right,
Phone.
welcome everyone. Welcome, the old guys. It's going to be as regular as we have been doing it in the past. So I'm just going to give you guys few breakdown using smart money concepts from Euro USD and to maybe gold and some other pairs, then you can go do the same on your own based on what you know and how you do your stuff. So it's going to be an insight um from previous sections that we have had. So if you want to get an update on any of the sections, you have access to the library, and the library link is within the academy. So you just go to the library, go to any of the previous videos, and then you can get yourself up to speed with whichever method I mentioned and you're not familiar with. Or you can use the YouTube channel. Most of the recordings are also on the YouTube channel. So this is Euro USD on the daily time frame. It's a new week. We are still within October, and we have seen a bearish reaction so far. Like I told you guys, on the monthly time frame, we have a lot of price action, but this is not where you come to look for structure and any of those stuff. This is the monthly. So what you just do is focus on the previous five candles because this is the previous 5 months. Okay, you don't need most of this information. You just have to know the trend and also the previous 5 months reaction on the candlesticks. Then you'll be able to tell what's to come next. Okay. And please also, if in case we have a terrible sound due to my network, please know that the recording will be clear. So probably when I edit the video and send the recording to YouTube, you can go and watch it clear. Okay. So if you're having issues with my sound, just know it's from my network or something like that. So this is Euro USD and this is the monthly. So on the previous five candlesticks, this is the first official bearish candle we are seeing. As you can see, the first official bearish candle. The market has been bullish, but on a very, very slow price action. So if you zoom in, sorry, you would also notice that we have kind of like a resistance here, a support, sorry, also with a support over here. Okay, we would also have an equilibrium level around this range. So if you're using market structure to observe the current range, when I say market structure, I mean this. Okay, so this is a low, a high, a low, a higher high. So this is kind of like a bullish structure right now. This from the beginning of the year, it's been forming a bullish structure. So this is the current structure we're observing. This is the monthly time frame. What we'll do is pick the key levels close to the price action. Okay, this is a key level. You can see the drop base drop concept from this point. So this is kind of like a supply zone, let's say. So we have then this range to worry about because other than price heading to this point, anything below will be within this range. Okay, so anything above will be within this previous range. So if you zoom out and observe the structure from this previous range, what we'll see is it's a bearish trend currently retracing. So using the premium and discount aspect, we are currently at equilibrium of this previous range. So the previous um, massive bearish reaction we saw in the market, like kind of like a recession, similar to what we are having now, just that this is kind of like undecided since February 2023. We have been in kind of a low momentum price action. You can see price has just been choppy. But previously, before that, we had the 2020 incident with COVID-19. So that caused this massive drop in the market. The market has been recovering until we got to this resistance level where we have been seeing this choppy price action. So this is kind of like a current trend in the market, which the market is not really in a direct trend, it's just within a consolidation. So, and it's currently at equilibrium of the previous range. This is testing discount and premium. So it's not on one side, it's kind of like on both sides. So we don't know if it's going to go higher or if it's going to go lower. Okay, so this is the kind of like information you need on the monthly time frame to keep you updated on what's going on. But on your entry, you're going to be needing just this information, this single candlestick, to know what to do. But when it comes to understanding the trend, you just have to focus on the informations you're getting from multiple candlesticks at once. Okay, so with that being said, I'm trying to give this section as fast as possible because I also have kind of like a family issue to attend to right now. So I'm doing it in a way that we can just have the recording and also go through it. And then at the end of the section, we'll take questions too. But I want to give you guys a lot of details when it comes to analyzing, no matter the concept you're using, smart money concept, Wyckoff. These are very important details that can help you on the monthly time frame before you can move down to a specific strategy you'll be using to trade the market. Okay, so these concepts are basically general when it comes to technical analysis. So since we're doing technical analysis, you have to know these things. Then you can go and watch the recording and do the same on different charts too to try and understand what's going on. Okay, so this is going to be a kind of a general section on analysis, not on a particular method. So I'm going to be fluctuating from supply and demand, smart money concepts, mentioning this, mentioning that. But whichever you don't know, you can easily catch up with from any of the YouTube video. Okay, all those have been prepared for the past 1 year now since I left school. I've been making sure I put everything in the public so we can also quickly recommend things to the public instead of having a private channel, something like that. So are you guys following up? Hello?
I hear you. It's a little bit choppy, but most of the time I hear you.
Oh, okay, okay. I'm just happy you're currently in the section, so um we can use it, to ask questions as well at the ending. Then the others can catch up with the recording. So on the observation of market structure, what we will have is price clears liquidity here, and this high is currently holding the trend. So you can see the supply zone within this level is what's currently resisting market from going higher. So this is the current swing high. Okay, we have this as a low, which broke the previous low that created this high. So saying this now, we would say this is a bearish structure, basically, because we cleared liquidity here and then broke structure here. So cleared liquidity, break structure. This is kind of like a bearish sign. But at the same time, we see the internal structure follow-up, which is what we have here. Created a low after mitigating the supply zone that we have at this swing level. But from what we can see here, the supply zone failed to break the swing low. From what we can see now, the supply zone failed to break the swing low. So this is also a sign that price could be going bullish because we also have a demand zone available at this point. Do you understand? So looking at this now, we are caught in a range. This is why I say market is currently in a consolidation zone. It's kind of undecided when it comes to the trend. The trend is stuck. All right. So if it's going to be a lower trend, we're supposed to be seeing a lower low from here. That is, the structure would have looked like this. And if it's going to go bullish, then we're going to see something like this. All right, so understanding this now, this becomes an area of interest which hasn't been mitigated yet. That's where the current monthly candlestick is heading to. So this is catching up with the current market structure of the monthly time frame. I want to give you how I decide the trend. So it doesn't sound like I just come to the monthly and then I pick a candle and I say the trend is bullish. I'm showing you why I say the trend is bullish and why I say the trend is bearish. So this is how I know. Okay, this is how I know the trend is bullish or bearish at the moment on the monthly time frame. So this is all the information I need on the monthly. Every other thing would be something we would catch up with from the weekly and the daily time frame. That would be what we would consider a higher time frame analysis. What we have from the monthly to the weekly to the daily. Okay, so now we head to the weekly time frame. Understanding we have a bearish area of interest here, a swing high here, and a supply zone here. Okay, so on the weekly time frame, we would have this. So are we following? Does this make sense? Any questions so far? Anybody's confused or anything looks complex?
The top and the swing high and the swing low, that's what you would external liquidity, right?
Yeah, but that's on the monthly time frame. Now we are scaling through multiple time frames. Okay, so I'm going to break down what it looks on this time frame, which is also going to give us confidence to what we are going to be deciding on the lower time frame. Okay, but yes, swing highs and swing lows are not liquidity mainly. They are used to identify the external point of market structure. For example, what we have here are multiple highs and lows, right? The swing point of this structure will be this point being the swing high and this point being the swing low. This point being the swing high and this point being the swing low. So swing highs and swing lows are the external points of market structure. How they become liquidity is if it's a bullish market, this high is what we call external range liquidity because it's going to get cleared out. It's in the way of the trend. This high is what we call external range liquidity. And then this low will be
Right.
what
And
we call a strong low because it's currently in the direction of the trend. This low is what we call a strong low. This is what we call a weak high, because it failed to break the low that created the high. This low created this high. It failed to break it, means this is weak. This becomes liquidity.
I
So,
see.
so the
Now
concept,
I got it.
yeah, so the concept of swing high and swing low comes in with understanding structure. They are also liquidity, but not all. If you understand the trend and structure, then you know how to use swing highs and swing lows.
Right. So now that to the right of that, the next bottom, the next low, swing low, um, that broke that first circle, right? So does that become um
You mean this?
well, no, so a little bit more to the left, to the bottom, to the center of the screen. Low, yeah, the bottom of that to the left, like lower than that. The
This?
bottom of that whole, yeah. Yeah. So since that's lower than the swing low that we identified before, which is the next bottom to the left or two over,
Yes, I get
um,
it. So would this be considered a
right.
bullish?
So the next bottom, right. And what about the next one? It's also to the left. I mean, it's also liquidity. Yeah, that one. So relative to that, that first one also becomes liquidity, right?
Yes. Okay, that's a good one. Now, if you pay attention to what we have here, this would be the previous structure before this incident happened, right? So when we were
Right.
on the monthly time frame, we saw something like price did a little liquidity swap. And then we just got a little insights based on the structures following up. We had this resistance here, and then we had this lower time frame structure. But let me see. I think I'm having some network issues supposed to be loading. All right, so on the monthly time frame, the lows you pointed out would be this and this. So basically, we're talking about this liquidity. This significance is now showing that we had a breaker block here that got mitigated. A breaker block is kind of like another block that is sitting at a swing high or a swing low that never got mitigated, but instead got a break of structure. Okay, that's basically the concept of a breaker block. This will be considered a breaker block, which this will be considered a mitigation. I just hope we're following up with that. So a breaker block is kind of like when you have another block and price break the structure, it comes back within the other block to retrace, to recover, the orders that was within that breaker block. So the breaker block is resting at a swing point as well, just like another block is resting at a swing level. So if we have a Quasimodo pattern, a breaker block will be resting at this point. Sorry, another block will be resting at this point, right? So when price comes back to mitigate the other block and then break structure instead of going higher, so price breaks structure instead of going higher. Now, this is another block it was supposed to hold, but there's a break of structure. So price retraces to recover the orders within this place before going back lower. So this is considered a breaker block, no longer another block. So a breaker block and another block has the relationship, but when it fails to hold, is now called a breaker block. Okay, so this.
Can you clarify one thing?
Yeah,
The breaker block is the red one or the um wh- which which candle is the breaker block?
the red one,
The
because
red
it's
one's the breaker.
it's
Yeah,
supply and demand. It's supply and demand. This would be a drop-based drop. So this is the supply zone. All right. So the other block would be this guy here, this red candle here. That's on this time frame. So price broke this structure with this candle. When this candle, did the manipulation here, it was supposed to drop from this point. Just like how you have this black one as the demand zone. So you see, mitigated it and went higher. Higher to mitigate this one here. This is an IPA candle. So you see, also did the same thing to mitigate this one here. It is so when it holds, it's like another block. But when it fades, it becomes a breaker block.
which really means it's broken, right? It's not breaking something else.
No, it's broken. Yes, the structure has been broken. For example, what we have here too. So the structure, look, this was a bullish structure, right? This was not
Right,
supposed to break. If it was still bullish, it's supposed to tap here, then go back higher. But when the structure breaks, the concept of this is not just within the candlestick. Orders were made here. The last
right.
bullish order, bearish order was made here before this bullish momentum. So the concept of order block goes into the name that orders were made. There's a block of order. The last
Right.
bearish order was made here. So the concept of smart money says that, price later retraces to recover those orders that were made. So if you look at this point, the specific area of mitigation would be this point of this. We are now moving into support and resistance, the Malaysian support and resistance method. But that method in particular breaks down order blocks into understanding the specific areas price mitigates them. Okay, so there's a specific area within the order block price does the mitigation mainly. As you can see also, We have a similarity here. We also have the similarity at this point.
Right.
So you can also see the similarities here as well.
And what's the role of a mitigation? Like, what does it mean to mitigate?
Mitigate is like taking out an order. When an order is executed by the institution, like buying or selling, so they had to take out an area of interest, which is taking out liquidity, or to mitigate structure, which is taking out a previous order that was placed. So the orders that were made here, we still have money within this point that has to be cleared out. So mitigating this area of interest is like filling the orders within this block here. So this was filling an order. Filling an order is like mitigating. So the term mitigation, I believe, goes into filling a spot. That's like an imbalanced spot. It's being filled. So, but when we don't say
Yeah, I mean,
mitigation, we mean it's clearing out that point. So this was a clear out. So they cleared out the liquidity here, okay? But they had to retrace back to mitigate the money which was made here because there was a big bullish push here. A bunch of money was placed here that pushed price against this order. So those money has to be recovered. So the recovering of the money is now the retracement, which is the breaker block being recovered. Okay, so this was a break of structure on the lower time frame. Then the recovery was also made within this same structure. Don't forget, this is the monthly time frame. Okay, so this is also a mitigation of the orders that were made here. This is also a mitigation of the orders that were made here. So
yeah.
if you
And
look,
what
yeah,
when a breaker block is mitigated, so what does that tell you for the future? How do you use that?
when you have price mitigating a breaker block, instead of clearing out that area of interest, that goes into understanding structure as well. So if the market is still bullish and you have an order at this point, let's say this hasn't happened yet, okay? So you're expecting price to retrace back into premium or discount of this current range. Let's say this hasn't happened, okay? So we are just at this point here. We have just
Right.
this high and this low. So you're expecting price to return back into discount of this current range price to give you an entry. So your area of interest would be you have a breaker block around this point. An order was here and then got broken. Okay, so this was a swing high as well. So you have also another block at this swing low as well. It's something like this, and then something like this. That's what we have here and here. All right. So you want to know, you don't really know where price is going to be mitigating. You don't know if it's going to be this guy or if it's going to be this guy, right?
Right.
But when you have a mitigation like this happening on this point, then you can go to the lower time frame of this bullish candle to get a confirmation entry based on the reaction you're having of the mitigation. If you then have a break of structure instead, which is like saying we had something like this. Not bullish, it went bearish. This also tells you that you're likely going to go bullish from here to recover the orders from this point, then continue bearish, which is the internal structure respecting itself, price going bearish on the long term. Or you're going to be having something like this, which is what we have here. What we have here. So that was what we were looking at on the lower time frame. Price mitigated this area of interest and then came back down to mitigate this instead of breaking. So if we were still bearish, price would have broke this point to create a new lower low. So we didn't have a lower low here. We had a lower low here, breaking this internal structure, but we had a lower high, and now we're having price heading to clear out this structure. So this is like saying it's kind of going bullish. So the mitigation and the breaking of structure helps you to understand what structure is doing. It's just giving you an area of interest. So if you know how the order block and breaker block works, then you have an area of interest here. You have an area of interest here. You have an area of interest here. You have an area of interest here, which is kind of like more specific on where to enter at the moment, just like how I get my entries. And I'm like having a sniper entry from price. This is how I get my sniper entries. It's just like having a specific point of interest. That's why it's called an area of interest. Do you understand that?
So in the diagram all the way on the right that you drew, at what point would you do something based on the based on the price action, meaning whether it goes up and turns bullish at the higher mitigation order block, or what do we call it, breaker block, or the lowest one, which was a strong low. So would you take a trade within the structure that you drew, or would you wait for either the break of the strong low to go bearish, and then once it retraces, or how would you trade this?
Okay, so now we have multiple time frames. This is the monthly time frame. Okay. On Forex, you don't have to hold price for 3 months because trading from this point to this point is trading 1, 2, 3, 4, 5 months, is holding a 5 months trend. That's a really, really serious swing trader. Okay. So in Forex, you don't have to hold this for this long, but you can. You can actually. And you can also get a re-entry from this area to go higher if you're right. But why we have multiple time frames is to scale down your time of entry. That's why, if you remember when I started the analysis, I told you guys on the monthly is not where we look for entry. So we're going to pay attention to the structure and the time frame. So we have the leverage to use multiple time frames. Nobody told you to use only the information you get on the monthly to get a specific entry from here and your stop loss below here. That would be too big of a loss to handle. So you go down to the daily, which is where you start to do what we call refining. That is refining the area of interest to the closest point, which is breaking this down to something like this. Breaking this down to something like this. So I was not refining it here. So because it's the monthly time frame, so you can get a clear understanding of what we're doing. But when you start to refine to the lower time frame, you start to find also lower structures within these points where you can see things like this also in these swing areas. Okay, so refining comes in place, which makes your area of interest even more smaller. Do you understand? So you don't look for entries on the monthly time frame. You get the trend, you understand the structure, then you refine your area of interest to the lower time frame to get a more specific area and a more smaller stop loss order, something like that. But this,
That makes a lot of sense.
yeah. So, but
Um, I
go on,
I
go
have
on.
a question though. Do you hear me now?
Yes, yes, I can hear you. Hello.
That you would want to refine the entry when it comes to, or refine the time frames in order to get to lower your risk in an entry. When it, however, when it comes to, if let's say you're in a losing position or to exit a position, do you also want to go down and down to get the finest answer so that you can maximize your gain, or let's say minimize the loss if you're in a losing position, that you don't want to exit the losing position if you could squeeze out a couple more pips Or like, do you get out early based on a bigger position and just say, call it a day, you know, go to the next trade, don't waste your time? Like,
Yeah.
how do you deal with refinement in an entry versus an exit?
Yeah, well, when it comes to that, that's where we have the trading plan. That's where your trading plan comes in. All right. So we have this is technical analysis for the chart. Then you also have your risk management and your trading plan for the trade. There's this trading plan graphics, which I post mostly on Instagram. If I'm editing the video, I'll put it up on the screen, I believe. And then this trading plan gives you questions like that for you to ask yourself. Because when it comes to how much you can lose, it depending on how much you're trading. And we all have different, figures we are currently trading in the market. So I can't give you my own trading plan, like saying, take out this, take out that. But I can give you the format, which you can use to form your own trading plan based on how much you're risking in the market. So we have something like when you're in a trade and you are using, let's use a trading plan for $100. On a single trade, you won't want to lose 50% of your entire equity, which is $50. So you're going to be refining both your stop loss and your lot size. So that will be where you use a lot size like 0.1, 0.10. Okay, so 0.10 lot size cuts each pip move to $1. So one pip will be equivalent to $1. Okay, so if you're looking at a stop loss of 20 pips, that is after you have refined, let's say we went down to, this is a 2-hour time frame. Okay, let me take all this out. Let's say after you're refined, and for example, there was a trade I took last week from this particular order block we have here. So the analysis was shared in the community. If you can remember, there was a trade that I identified with this liquidity here. Now, an entry from this point would look like this. And my take profit was this external high. Okay, sorry about that. Okay, so this was the internal the liquidity, and this was the other block. This was the external high. Then if you look at the structure, we're looking at this. So that's a bullish structure. And then if you look at within the internal range of this structure, we have this. So this was the bearish retracement. Then this was the bullish breakout, mitigating this area of interest. Yeah, so on the lower time frame, you have this. So it's a bullish structure, and this is kind of like a swing point with another block on it. Okay, so that's why that was respected, highly respected, because of the confirmation. So on the entry aspect of this would be refined from a higher time frame, because on the higher time frame, this would be the area of interest. Okay, I just hope you're understanding that. And then what we would have, this would be 29 pips stop loss. So if my stop loss was below this and I was using 0.1 lot size, price breaking this low would stop me out on $29. But price clearing out this high would be a total profit of, this is over, I think, 53 pips or so, something like that. Okay. Okay, that's
Yeah,
58 pips. 58 pips, which would be $58. Remember, we're using 0.10 lot size, which is 1 pips is equivalent to $1. So refining makes this much easier, because if your entry was at this point, that would be, this would be around almost 51, almost 50 pips SL stop loss. So if you lose 50 pips. If you win 51 pips. That's not really a fair trade. This is almost a 50-50 trade. And that's not really a fair trade if you ask me. That's not really trading, that's gambling. But when you have a strategy that brings it down to this
Make
point,
the high. If
yeah, if your entry is at this point and your stop loss is your take profit is at this point, then what's the essence of analyzing? We can just buy and hope for the best. This is gambling. If you lose, you lose. You win, you win. But when you have something that brings your area of interest down to a point like this and gives you a chance of winning, then this is trading. This is what I consider trading. So we have less than 1 minute on this Zoom. I will just, tap the link and then we will just restart the Zoom and then we can continue from where we stop, okay? So this Zoom is about to end and then we can continue the class. But let's just process this at the moment and, understand. I just hope this was able to answer your question at some point.
question is why would you um the reason you went bullish here at mitigation is because